Oregon students are required to take closed book midterm and final exams that are proctored exams. This is an Oregon Tax Board requirement, not our school's requirement. And because the test must be proctored, you need to be thinking ahead about when and where you will be taking the test. The closed book midterm exam is similar to quizzes you have been completing throughout the course. The Oregon Board of Tax Practitioners again requires that that test be proctored. If you have not already submitted a proctor application to Pacific Northwest Tax School, you must do so at this time, unless you live within 1 hour's drive of our office here in Portland. If you do, you will need to take the examination in our offices, physically come to the school location to take your test. If you are going to be taking the test in our offices, contact Nancy Alshire at support@pnwtaxschool.com to schedule your appointment to take the test. If you live more than 1 hour from Portland, you can use a proctor. Pacific Northwest Tax School must approve your proctor, and typically we will approve colleges, high schools. Sometimes we will approve public libraries who have facilities where proctoring can be done. It is extremely rare that we would approve anyone other than an institution. So you need to be looking for institutions in your area. And again, Nancy Alshire does have a list of institutions that have proctored for us in the past. Now, both you and your proctor must submit applications to Pacific Northwest Tax School. The proctor applications can be found inside the Sessions Materials page of Session 1, Session 8, Session 12 of the Basic Tax Course. So we put those in numerous places that you should be able to have access to them. When you are ready to take your test, and after your proctor has been approved, you would contact your proctor to schedule a time to take the midterm exam. So at this point, let's move on with Session 8 of the Basic Tax Course. Hello, and welcome to Session 8 of the Basic Tax Course. We're going to begin Session 8 with a review of the Session 6 quiz answer key. I have on the screen in front of you a copy of the Session 6 quiz. The first question we will review as a most frequently missed question is question number 1, and it reads, you are married filing separate. You did not live with your spouse at any time during the year. Your income consisted of $19,000 of pension income and $1,000 of municipal bond interest. You also received $12,000 of Social Security benefits. What portion of your Social Security benefits is taxable on your return? And you can see that I've circled 500 as being the correct answer. Now, by the time we get to this point in the course, we've been discussing Social Security for a full session. We've been looking at assignments involving completion of the Social Security benefits worksheet. And there's a key formula in there. It's a multi-step formula, but the first part of the formula says, take half of your Social Security benefits. Add to that all of your other income, including tax-exempt interest. And if the total exceeds $25,000 for your filing status or $32,000 for a married filing joint, then your benefits become taxable. There's also a second base amount, and for married filing separate but did not live with your spouse at any time during the year, and for single, that second number is $9,000. If you take all of your income, including tax-exempt interest, add in half of your Social Security benefits, and then subtract out $25,000. If the difference between $25,000 and the amount of income you have is less than $9,000, if that difference is less than 9, then you simply take that difference and divide it in half, and you have your answer. So let's take a look at how this problem works. The first part is we have $19,000 of pension income. We add in the tax-exempt interest, and we add in half of the Social Security benefits. That gives us $26,000. Well, the base amount for married filing separate but did not live with your spouse at any time during the year is $25,000. So we subtract $25,000 from $26,000, and we get $1,000. Well, $1,000 is less than $9,000, so the only thing left to do is divide $1,000 in half, and we're done. That's our answer, $500. The next question in line was the mini problem for Session 6, and it involves characters named Jonathan and Martha. Jonathan is born in 1944, and Martha is born in 1946. Jonathan retired from his job with the U.S. Postal Service on June 1st, 2009, after 30 years of service. The tax-free portion of the annuity recovered in 2009 and 2010 was $1,838. Well, this is a number that we are providing you because you're going to need to enter it on the simplified method worksheet. During the year, the Kents had the following combined sources of income: savings bank interest of $2,500, tax-exempt interest of $1,000, an annuity for Mr. Kent in the amount of $25,000, gambling winnings in the amount of $600, and Social Security benefits in the amount of $15,000. Now, next to the annuity amount for Mr. Kent, we tell you that the contributory amount he paid for the year was $30,000. So let's take a look then at how we're going to take these numbers and figure out two items. And the two items that the problem says to do are to complete the simplified method worksheet and the Social Security taxability of Social Security worksheet. Once you've done those two worksheets, then you'll be able to answer the questions that follow. So let's go take a look at the answer key for the Kents. And you can see I've got it right here. I'm just going to pull it over. The first worksheet that we're going to complete is the simplified method worksheet to determine the taxable portion of Jonathan Kent's annuity payments for the year. The starting point on line 1 is to enter the total pension or annuity payments from Form 1099-R Box 1. Now, we didn't provide you with a 1099-R. We simply told you what his benefits for the year were, and those were $25,000. Then it says enter your cost in the plan, and that would be the contributory amount he paid into the plan. That's $30,000. The next step is to look at the age of the beneficiary and his spouse combined on the date of retirement. And this is what tricks people up, because it isn't their combined ages today as they're receiving pension income today or annuity income today. It's their combined ages on the date of retirement. So let's go back to the problem and read the wording of the problem. Jonathan was born in 1944 and Martha was born in 1946. Jonathan retired in 2009. So how old would Jonathan have been in 2009? Well, we go 1944 minus 2009. That means he was 65 years old in 2009. And Martha in 2009, born in 1946, was 63 years old. So you take 63 plus 65 and you get 128. That is the combined ages. So you move over to the worksheet, and at the bottom under Table 2 it says if the combined ages of the annuitants on the starting date were between 121 and 130, then the amount to enter on line 3 is 310. So in order to select the right line, you have to add up the correct age on the date of retirement. So we take 310 and enter that on line 3. The next step is to divide line 3 into line 2, and when we do that, we get 96.77. 96.77 is entered on line 4. That is the amount that Jonathan can recover each month tax-free. How many months did he receive his annuity for in 2011? Well, that would be 12 months. So 9677 times 12 equals 1161, and we enter 1161 on the line. Line 6 asks for the prior year amounts recovered tax-free. We gave you that in the wording of the problem. It's $1,838. We then subtract $1,838 from $30,000, and we get $28,162. The amount that Jonathan can recover tax-free for 2011 is going to be the lesser of line 5 or line 7. Line 5 is the lesser amount, so we enter that amount, 1,161, on line 8. And we subtract line 8 from line 1, and that leaves us $23,839. That is the amount of income that Jonathan must pay tax on for his annuity received during the year. And the amount he is allowed to receive but not pay tax on is $1,161. The final stage of the worksheet is to take the amount recovered tax-free for 2011 and add that to the amount recovered tax-free for the earlier years. So we have $1,161 plus $1,838 is $2,999. Moving on, the next step of the Kent's mini problem is to move on to the Social Security benefits worksheet. And we can't do that worksheet without first having completed the simplified method worksheet. And the reason for that is we need to figure out how much income the Kents have from their pension. And the answer now is $23,839. So we move on to the worksheet. So moving on to the Social Security benefits worksheet for the Kents, the starting point is to enter the total Social Security benefits they receive for the year. And you can see I have the problem open on the screen here on this side, and it shows that the total Social Security benefits they receive for the year is $15,000. So that's the starting point on line 1. Line 2 says take line 1 and divide it in half, and when you do that, you get $7,500. Then on line 3, it says combine the amounts from line 7, 8A, 9A, 10 through 14, 15B, 16B, 17 through 21. Well, how much income does that total for the Kents? It includes the taxable portion of his annuity. It includes the interest income. It includes the gambling wins. And the total of that income is $26,939. So we entered that on line 3. Line 4 says enter the amount, if any, from Form 1040 or 1040A, line 8B. That is the tax-exempt interest amount that Jonathan received, and that amount is $1,000. So we total up lines 2, 3, and 4, and we get $35,439. Well, the next part of the worksheet is to enter the base amount for the filing status of the Kents. The Kents' base amount is $32,000 because they are filing a joint return, so we enter that on line 9. Now we look to see the difference. Line 8 minus line 9. Is it a positive number? And the answer is yes, it is. Is the difference between these two numbers greater than $12,000? Because $12,000 is the next number we see on that worksheet. And the answer is no, it's less than that amount. That means whatever amount we calculate on line 10, we're simply going to divide that in half, and we have our answer, $1,720. But let's just see the worksheet walk us through all of this anyway. So we start on line 9. We enter $32,000. From line 8, we subtract line 9, and we enter that total, $34,39 on line 10. Next, we enter $12,000 as the second base amount for the filing status married filing joint. And then it says subtract line 11 from line 10 or enter 0 if it is less than 0. And in this case, it's 0 because obviously the line 10 is less. Next, it says to go up to line 1 and multiply that number by 85%. When we do that, we get $12,750. We then take line 15, add that to line 16, and then we take the lesser of that total, or line 18, and in this case the lesser amount is $1,720. So that concludes the review of the Session 8 quiz answer key. It is now time to move on to a review of the Session 7 homework assignment. And I have on the screen in front of you now homework assignment A for Session 7. It states that for questions 1 through 4, determine the maximum allowable contribution each of the following people can make to their child's Coverdell ESA. Remember that you have to deal with a phase-out limit here, and for Coverdell ESA contributions, you can make a contribution to a Coverdell ESA as long as your income is below $95,000. If your income exceeds $95,000 but is less than $110,000, you can still make a contribution, but your contribution will be limited and subject to a phase-out. If your filing status is married filing joint, you can take that phase-out range and double it. So for married filing joint, the income phase-out range is $190,000 through $220,000. So let's begin with number 1. Luke Skywalker is single, and his modified AGI is $100,000. Well, where does that put him in the phase-out range? 95 through 110, 100,000 is clearly $5,000 into a $15,000 phase-out range. What that means is he will be allowed to contribute up to 2/3 of the maximum amount. Well, 2/3 of the maximum amount, that would be $1,333. The maximum allowable contribution that Luke can make during the year is $2,000. His income is too high. He is allowed to put in 2/3 of $2,000, and that is $1,333. The next problem is for Annika and Padme Skywalker. They are filing a joint return, and their modified AGI is $190,000. Where are they in the phase-out range? Well, they're at the bottom of it. They're not going to be hit by a phase-out at all. Therefore, they can contribute the full $2,000 to their child's Coverdell ESA account. The next one in line is Mr. Darth Vader. He is married filing separate, and his modified AGI is $80,000. Where does that put him in the phase-out range? He's not affected by the phase-out range at all. His income is simply too low. He can contribute up to the maximum amount of $2,000. And finally, Obi-Wan Kenobi is single, and his modified AGI is $96,000. Where does that place him in the phase-out range? Well, the phase-out range is a $15,000 range beginning at $95,000. He is $1,000 into a $15,000 phase-out. Therefore, you will go 14/15 multiplied by 2,000. And that gives you $1,867. So the maximum amount that Obi-Wan can contribute to his child's ESA is $1,867. That concludes the review of Homework Assignment A for Session 7. Let's move on now to Homework Assignment B. Homework Assignment B involved preparation of a tax return for the solos who are filing a joint return. And the information in here that is relevant is, of course, you need to look at their ages. Leah was born in 1967. Han was born in 1965. Neither of them are age 50 yet. That's important for figuring their IRA contribution limits. Han contributed $2,500 to his qualified family coverage HSA during the year. His annual HSA deductible is $5,000, and during the year he withdrew $2,000 to pay for unreimbursed qualified medical expenses. Han and Leah want to make the maximum deductible IRA contributions that they can and then contribute the balance of their allowable contributions to their Roth. They have not made any non-deductible contributions in prior years. So we're providing you with the information necessary to complete Form 8606 for Han and Leah if either of those are required. Now, during the year, Leah paid $1,500 of student loan interest and received $12,000 of unemployment. The solos both want to contribute $3 to the Presidential Election Campaign Fund. Their W-2s and 1099-Rs are attached. Prepare their federal tax return and then answer the questions. Well, let's take a look at the W-2s again. Here we have Leah. She is the primary taxpayer on this tax return. You know that because we have listed her name first right here. And the amount of income she has is $40,000. She has nothing going on in terms of salary deferrals. You can see that her retirement plan box on her W-2 is not checked. Then we move on to Han's W-2. Han's got a little bit more going on. Firstly, we can see that for Han's W-2, his retirement plan box is checked. And we can see in box 12 that he has made salary deferrals to his 401k plan. There is a code D, which represents 401k plan salary deferrals. Underneath that is another box. It says code W. And the code W represents employer contributions to an HSA account in the amount of $2,000. So when you see a code W on a W-2, that tells you that there were employer contributions to an HSA, and those need to be reported on Form 8999. The next document in play is the Rebellion Incorporated 1099-R. You can see that there was a gross distribution of $1,000. There is some withholding. The distribution code is 1. You can see that the IRA box is not checked. And because the IRA box is not checked, that means that the filer is going to be reporting this income as pension income rather than IRA income. Also, because there is a code 1 in box 7, it means that there will be a penalty unless we've provided information or the taxpayer provides information to you that would indicate there might be an exception. And we've not provided you with any information to tell you that there is an exception. So essentially, Han is going to need to pay a penalty on this early distribution. So let's now turn to the answer key for homework assignment number B. Han and Leah's modified adjusted gross income is $98,500. Adjustments for student loan interest and IRA contributions are not a factor when calculating modified adjusted gross income for purposes of the IRA deduction. So there is adjusted gross income and then there is modified adjusted gross income. And when you fill out the worksheet for calculating the deductibility of an IRA deduction, that worksheet tells you what deduction items or adjustments to income items can be factored in determining modified adjusted gross income. So when we get to that worksheet, you will see how we calculate this figure of $98,500. Since Han is an active participant in his company's pension plan, he is not eligible for a full IRA deduction. We're going to calculate the maximum allowable deduction as shown on the attached Form 8606 worksheet. And since the solo's modified adjusted gross income is less than $179,000, and because Leah is not an active participant in an employer-provided plan, she is allowed to claim a full deduction for her contributions to her IRA. Han will claim a $2,500 HSA deduction on his Form 1040, line 25, and he will need to attach Form 8889 to show how he calculates that. And then there was also a distribution from his HSA, but since the distribution was used to pay for qualified medical expenses, that distribution will not be taxable. But again, we need to fill out the 8889 to show that computation. Finally, Leah will claim a $1,500 student loan interest deduction, and let's take a look at their 1040. Beginning on 1040, we have the filing status is married filing joint. Their daughter Alexandra was born, if you go back here and look at the wording of the problem, in 1999. And that means that she is under the age of 17, and because she's under the age of 17, she does qualify for the child tax credit. We take the solo's W-2s and add them together, and we get $88,000. Then on line 16B, we enter the early distribution from the retirement account. That was $1,000. And then on line 19, we enter the total amount of unemployment that the solos receive for the year. And we gave you that information right here, $12,000 of unemployment. So that unemployment is entered on line 19 of the Form 1040. Their total income on line 22 is $101,000. We then enter the amount of deduction that the solos can claim for Han's contribution to his HSA. That amount is $2,500, and we will show you the 8889 in just a moment. Then on line 32, we're going to enter the total deductible amount that the solos can claim for contributions to their IRAs, and we will need to complete the worksheet for line 32 to determine the number, but I can tell you right now that Leah will be making a deductible contribution in the amount of $5,000. Han's deductible contribution is $2,880, and when you add those two numbers together, you get $7,880. Then on line 33, we enter the amount paid for student loan interest. That's $1,500. Their adjustments total $11,880, and their adjusted gross income is $89,120. Moving down to page 2, beginning on line 38, we have the AGI at $89,120. We're claiming a standard deduction of $11,600. Exemption deduction totaling $11,100. That would be 3 times $3,700. We arrive at taxable income of $66,420, and the amount of tax on that income is $9,114. We then claim a child tax credit for the solo's child, and we end up with a total tax after credits of $8,114. The solos are not eligible for any exception to the early distribution penalty. That penalty is $100, and we've entered it on the line. You will note that on the line we also typed the word no, which indicates that Form 5329 is not required. Total tax for the solos on line 61 is $8,214. They had $6,200 withheld, which means that they have a balance owing of $2,014. Here is the solos health savings account 8889 form completed. You can see that we've checked the family plan. And on line 2, we've entered the amount of contributions that Han made for the year. And you can see on line 3, we have the maximum allowable contributions that their family could make for the year. We do have to account for the contributions that were made by the employer. The employer contributions reduced that limit from $6,150 down to $4,150, but $4,150 is more than the amount that Han contributed, so we're left with line 13 showing the allowable contribution is equal to the allowable deduction. Line 14 is where we show the distributions that occurred from the HSA during the year. They totaled $2,000. We can see that there was $2,000 of allowable expenses. So on line 16, the taxable portion of the distribution is 0. Now we have the IRA worksheet, and the starting point that I did want to point out for you, and this has been a bone of contention with my students for many, many years. It still surprises me when it pops up, although it certainly shouldn't because I've seen it so many times. But there is an automatic assumption in the mind of many tax preparers and even some clients that the man's name has to go first on the tax return. There's no such rule. If you've read the instructions thoroughly like I have, there is no rule on the 1040 that says the man's name is listed first. So when you're looking at a problem that we've created where the woman's name is listed first, please do not flip that around when you're preparing the tax return, and please don't flip it around when you're preparing the worksheet for the solos either. Leah's name is first in the problem. You can see right here, Leah Solo is married to Han Solo, so we put her name first. And so you need to retain that continuity when you're completing worksheets. Therefore, Leah is the taxpayer and Han is the spouse for this problem. Moving on with this worksheet, we have Leah. She is not covered by a pension plan at work. We have checked the no box. Han, on the other hand, is covered by a pension plan at work, so for him, we have checked the yes box. Next on line 2, we answer the question, is the taxpayer covered by a pension plan at work? If so, enter $110,000, and if not, enter $179,000. Leah is not covered, so we enter $179,000. Han is covered, so we enter $110,000. And just as a reminder, the phase-out range for Han is going to be $90,000 to $110,000. We then enter the total income from the Form 1040, line 22. That was $101,000. Are we allowed to make any adjustments against that? Yes, we are allowed to claim an adjustment for that HSA contribution. So that gives us modified adjusted gross income of $98,500. The next step is to subtract line 5A from line 2A and enter the total on line 6A, and the same for column B. And when we do that, Leah has a phase-out range that is not going to be used up. She's simply going to be allowed a full deduction because this number is so high. But when we look at Han, we know he is into the phase-out range. That phase-out range is $90,000 to $110,000, or a $20,000 phase-out range. So we can see that Han is less than 50% into the phase-out range. He will be allowed a partial deduction. We move over to the second page, and on line 7, we enter $5,000 for Leah based on her age. That's the maximum amount she can contribute, and she will also be allowed to claim a deduction for that amount. Han is going to take his phase-out amount of $11,500 and multiply that by 25%. When he does that, he gets $2,880 when you round up to the nearest $10. And ultimately, Han is given a deduction of $2,880. Leah is given a deduction of $5,000. Now, the wording of the problem tells you that the solos will contribute any excess amount that they cannot claim a deduction for into a Roth account. Since Leah is able to claim a full deduction, she will make no Roth contribution at all, but Han will make a Roth contribution, and his Roth contribution will be $2,120. We simply take the maximum IRA contributions he is allowed for the year based on his age, which is $5,000. We subtract out the amount he is contributing to his traditional IRA, and then the difference is $2,120, and he will contribute that to his Roth account. And that concludes the review of the Session 7 homework assignment. At this point, please push pause on video playback. Complete the Session 7 quiz. And when you are ready, resume playback and we will begin the Session 8 lecture. Welcome to Itemized Deductions. You'll see up here at the top of the manual it says Part 1. There is a Part 2 to Itemized Deductions, and Part 2 of Itemized Deductions will cover the second or the bottom part of Schedule A. But today's class, we're looking at 4 categories of itemized deductions on Schedule A. We're looking at medical expenses, dental or deductible taxes, not dental, deductible taxes, interest, and charitable deductions. So that is the content of today's class. We are going to, of course, be covering itemized deductions, and in specific, we're looking at Schedule A at the items contained in this red box. We're going to be looking at medical and dental, taxes that you paid that you may be able to deduct on your return, interest that you paid, and gifts to charity. So throughout today's class, I will be referring to line numbers on Schedule A, and occasionally I will also be referring to line numbers on the 1040 form. If you have those forms handy, it will help you follow along with me better. You may not have line numbers memorized, and I will be referring to a line, and it may mean something to you or not, so if you have the manual handy, that's best. So we're going to start really at the beginning with some very simple stuff that most of you probably already know, but we like to cover all the bases. And the first one is, of course, that you use Schedule A to figure your itemized deductions, and in most cases, your federal income tax will be less if you take the larger of your itemized deduction or your standard deduction. And if you itemize, you can deduct a part of your medical and dental expenses, unreimbursed employee business expenses, and amounts that you paid for certain taxes, interest, contributions, and miscellaneous deductions. In some cases, you can also deduct certain casualty losses. So let's take a little bit of a look at some of the real basic stuff. Who must itemize deductions? Because there are some people who are required to. It's not even optional. The first one is if you are married filing separately and your spouse itemizes deductions on his or her return, well, then you're required to itemize your deductions. Whether or not the standard deduction is higher, you would be forced to itemize. The next one is if you are a non-resident alien filing Form 1040-NR. 1040-NR actually has itemized deductions built into it. It does not allow for or provide for a standard deduction. However, there is a tax treaty between the United States and India, and certain residents of India get a standard deduction on 1040-NR, but only residents of India. So who should itemize deductions? Because if you're not forced to, is it a good idea? Well, the answer is you should itemize your deductions if your total itemized deductions are more than your standard deduction, or even if your standard deduction is a higher number, in some cases you can still be better off itemizing if you are paying the alternative minimum tax. Under the alternative minimum tax, you are not allowed to claim a standard deduction. It is taken away from you. And so for that reason, you can be better off itemizing even if you only have a small amount of deductions to itemize. So what exactly are itemized deductions? Well, itemized deductions are deductions that you claim instead of the standard deduction. And of course, you can itemize your deductions on Schedule A, or you can claim the standard deduction, but never both. Now, if you do itemize, you have to file long form. You can't file short form 1040E or EZ or Form 1040A. You're going to have to file the long form. And of course, an important rule to remember about all itemized deductions is you are never allowed to double deduct, and that is really true for the tax code everywhere, but a lot of people have a hard time grasping that, so I've put it in big bold letters. Also, you have to use after-tax dollars to pay an expense that you wish to claim as an itemized deduction. In addition, you may not claim a tax benefit for the same expense in more than one way. If you claim an itemized deduction for an item that is also eligible for another tax benefit, you may not claim a double benefit. And here are some examples of where a tax benefit is available in more than one way that could impact whether or not you should claim that deduction on the Schedule A. Firstly, employer-paid or pre-tax health care plan at work. If you're already participating in a pre-tax health care plan at work, clearly you've got the deduction built in on your W-2 already, and you cannot claim the cost of your pre-tax health insurance as an itemized deduction. Also, flex spending accounts. Flex spending accounts allow an employee to put money, pre-tax money, into an account, and they can then spend money from that account on qualified expenses such as medical, and that also is pre-tax. So if you pay medical expenses with money inside a flex spend account, clearly you cannot take a deduction for those expenses. Also, if you have a health savings account or an Archer MSA and you pay for medical expenses with funds that are distributed from these accounts, you cannot then claim an itemized deduction for those same medical expenses. Now, in certain situations, you may be claiming a dependent care credit and have an expense that also qualifies as an itemized medical expense deduction at the same time. And we're going to talk about how that's possible as we get into today's class on itemized deductions. But clearly, if you are able to claim a dependent care benefit using an expense, you can't use that same paid expense as an itemized deduction. There is the new health coverage tax credit. It's been around for a couple of years now, but clearly, if you are able to claim a health coverage tax credit, you can't claim an itemized deduction for the same expense. And then there is health insurance premiums that are deducted by a self-employed person as an adjustment to income on Form 1040, line 29. If you're deducting your health insurance there, you don't put it on Schedule A and claim it twice. So with that introduction over, we're going to move on now to the first Schedule A topic, which is medical and dental expenses. And the IRS defines medical expenses as the costs of diagnosis, cure, mitigation, treatment, or prevention of disease, and the costs for treatments affecting any part or function of the body. Now, one of the things that I like to think about medical is, firstly, almost no one gets it. Secondly, if you do get it, the expense categories are broad. So what I find is there's this 7.5% limit, which most of you should be familiar with, and your deductions have to exceed 7.5% of your income. Your expenses have to exceed 7.5% of your income before they do you any good. But if you're able to hit that 7.5% and you start looking at the types of medical expenses you can claim, they're really, really broad. pretty much almost anything goes as long as you can show that it's medically necessary. But we will, of course, look at in detail the things that are not allowed and the things that specifically are allowed to help you get your brain trained to instinctively know the answer, because, of course, your clients will offer up items and say, hey, can I deduct this? And as a tax preparer, it's our job to be able to go yes, no, yes, no, yes, no. So when can I deduct my medical expense as well as an issue? So there's the topic of I have a medical expense. Is it a qualifying medical expense that I can put on my tax return as a deduction? But then if I paid medical expense for myself or someone else, is it an expense that I can claim on my return? So there's the idea of, is it a qualifying expense because it is medical expense? But then there's also the issue of, is it an expense that I personally can claim, or is it an expense that only someone else can claim? So you can deduct a medical expense only in the year you pay it, regardless of when the services or the treatment are provided. Payment is treated as paid on the day you mail or deliver a payment by check, if you are making a payment by check. The date reported on your financial institution statement if you use a pay-by-phone or online account to pay your medical expense, or the date you charged payment to your credit card if you paid by credit card. And it's important to note that the date that you actually pay the credit card bill is not a factor. Now, when I'm dealing with clients working on their tax returns, this concept of when I actually paid the bill often causes my clients confusion. And my staff, when they come to me with questions, are sometimes confused by this as well, particularly when it comes to a credit card. The IRS says that if you purchase something with borrowed money, that you have purchased it. It's paid for. The loan is a secondary issue. What they're concerned about is that you paid for the service. Paying off the loan is not what they're concerned about. And a credit card is, of course, a form of loan. So if you borrow money through your credit card to pay your medical bill, the medical bill is paid. The medical provider is not going to come to you and say, hey, pay me again because you didn't pay off your credit card. Who's going to come to you if you don't pay off the credit card? The credit card company. It's a completely separate issue. So that's the first thing. And then, did you pay that bill during the tax year? Did I pay for my medical expense during the tax year? Because nearly all taxpayers are cash basis. When it comes to medical, IRS says you claim a deduction on your 2011 return if you made the payment in 2011. If on December 31st you charged your medical bills to your credit card and you did not pay the credit card off until January of 2012, those medical bills will be treated as having been paid in 2011. As long as that's the date showing on your credit card, right? Now, here's a tip. If normally you would not have enough medical expenses in a single year to exceed the 7.5% rule, then you should plan to pay your expense in the most advantageous way. For example, David's AGI is $40,000, and he has scheduled a $3,200 corrective eye laser surgery for January of 2012. During 2011, he has already paid another $2,000 of deductible medical expenses. Now, if David pays his eye surgery bill in 2012, his other 2011 medical expenses are not going to be enough to exceed the 7.5% limit. If we take $40,000 and multiply that by 7.5%, we get $3,000, and so far he's only spent $2,000. So he spent a lot, but not enough. However, if David pays for his corrective surgery in December, his allowable medical expense for the year would bump up to $5,200. He would be able to claim a $2,200 medical deduction. He would take the $5,200 he puts out during the year, subtract 7.5% of his income, and the $2,200 that's left over actually gets to benefit him on his tax return. So, of course, if you're trying to beat the 7.5% limit, strategizing how you go about paying your medical expenses could be a smart idea. Trying to get all the bills paid in one year rather than spreading them out over time is essentially the trick. If David pays for the surgery by credit card in 2011, he will be allowed a deduction in 2011, even if he does not pay the credit card bill until 2012. And session 8, password number 1 is cowboy, C-O-W-B-O-Y. relative. So whose medical expenses can you deduct? You can deduct medical expenses you pay for yourself and the following individuals, provided they were paid during the year. Firstly, your spouse. If you are married filing separate, you can claim expenses you paid for your spouse, but only if you paid them after you were married. If you are married filing joint, you can claim expenses you paid for your spouse at any time during the year, so long as you were married on the last day of the year. For your dependent, this person must have been your dependent either at the time the expense was paid or at the time the medical service was provided. You do not need to claim a dependency exemption for your dependent. For purposes of the medical expense deduction, a person qualifies as your dependent if both of the following requirements are met. Number one, the person was a qualifying child or qualifying relative, and the person was a U.S. citizen or national or a resident of the United States, Canada, or Mexico. So earlier in our series of 1040 classes, we had a session called Filing Requirements, Filing Status, and Dependence. And in that session, we talked a great deal about the definition of qualifying child and qualifying in terms of dependency. But when we get into medical, we're looking at many of the same tests, but not all of the same tests. So the question for medical is, can I claim medical expenses I paid for a person who is my dependent? And the answer is they have to pass the tests for dependent as fits for medical, which is slightly different. The main difference between dependent for medical and dependent for actually claiming the exemption is that under dependent for medical, you do not have to be able to claim their exemption. And secondly, they can fail the gross income test. So there's a variety of tests that dependents have to pass, one of which is if they are not your qualifying child, they have to meet the qualifying relative rules, and under the qualifying relative rules, their income cannot exceed $3,700. When it comes to medical, that rule is thrown out. So it's entirely possible for multiple reasons that you would be able to claim medical expenses you pay for a person who is almost your dependent, but not quite for tax purposes. So let's take a look at what the IRS defines as a qualifying child for purposes of medical. A qualifying child is a child who is your son, daughter, stepchild, foster child, brother, sister, stepbrother, stepsister, half-brother, half-sister, or a descendant of any of them. For example, your grandchild, niece, or a nephew. And at the end of 2011 was under age 19 and younger than you or your spouse if filing jointly. Under age 24, a full-time student and younger than you or your spouse if filing jointly, or any age at all, so long as they were permanently and totally disabled. And this person must have lived with you for more than half the year, did not provide over half of his or her own support for the year, and did not file a joint return other than to claim a refund. Adopted child. A legally adopted child is treated as your own child, and this includes a child lawfully placed with you for legal adoption. You can include medical expenses that you paid for a child before adoption if the child qualified as your dependent when the medical services were provided or when the expenses were paid. What happens when you have children of divorced parents or separated parents? This is a good move away from some of the other rules about dependency because, of course, under dependency, only one parent can claim a child's exemption. If the parents are not filing together, one parent gets the child's exemption. But when we get to medical, the parent who pays the expense can claim the medical for that child, even if they're not claiming that child's exemption. But there are restrictions on it, so let's take a look at those. For purposes of medical and dental expense deduction, a child of divorced or separated parents can be treated as a dependent of both parents. Each parent can include the medical expenses he or she pays for the child, even if the other parent is the one who claims that child's dependency. If, so long as, the child is in the custody of one or both parents for more than half the year. So it has to be a parent who's entitled to the exemption in the first place. If someone else, third party, is the one that's entitled to the exemption, then neither parent would be able to claim medical. So we're looking at a child, divorced or separated parents. The child is going to one parent, and the other parent has paid medical. In that situation, that parent who is not claiming the child's dependency would still be able to claim the medical. Also, the child has to receive over half of his or her support during the year from his or her parents and not some third person. And the child's parents are divorced or legally separated under a decree of divorce or separate maintenance, are separated under a written separation agreement, or lived apart at all times during the last 6 months of the year. But this does not apply if the child's exemption is being claimed under a multiple support agreement. Qualifying relative. A qualifying relative is a person who is your son, daughter, stepchild, foster child, or a descendant of any of them. For example, your grandchild, or a brother, sister, half-brother, half-sister, or a son or daughter of either of them. A father, mother, or an ancestor or sibling of either of them. For example, your grandmother, grandfather, and or uncle. A stepbrother, stepsister, or any of those other steps. Brother-in-law, father-in-law, mother-in-law as well. Or you'll see here under qualifying relative, we have somebody who's not related to you at all. Any other person other than your spouse who lived with you at all times during the year as a member of your household, as long as your relationship does not violate local law. So one of the things that I know confuses people about dependency, and I get it all the time from all kinds of tax school students, as well as my tax clients, is this concept: can I claim a dependency exemption for someone who lives with me but is not related to me? For example, can a boyfriend claim his girlfriend as a dependent, or vice versa? Or can two friends who live together, who are not boyfriend and girlfriend, just friends who live together, could one claim the other as a dependent? The answer is, it is possible if you meet all of the tests. One of the tests is, if the person is not related to you, they have to live with you the entire year as a member of your household. They have to also pass all of the other tests for qualifying relative. But the first test that I always look at is, did they live with you the entire year? Because if they moved in February, well, they weren't with you the whole year. And if they moved out in November, well, they weren't with you the whole year. That would be a year that begins on January 1 and ends on December 31. That is a full year. So if they did, then they're going to meet this test, which is called the member of household or relationship test. So when we're looking at medical, can you claim a medical expense for someone who lived with you? The answer is possibly if they pass the tests, one of which is, did they live with you the entire year? The next rule under qualifying relative is, this person could not be a qualifying child of any other person during the year. A key point for qualifying relative is this is a secondary category of dependent. The primary category is qualifying child, and if a child passes the qualifying child tests for a particular taxpayer, they are automatically going to be a qualifying child, period. To have a qualifying relative, you have to have a dependent who is not a qualifying child. Cannot be the qualifying child of you or anyone else. So we're looking at, can I claim medical expenses I paid for a person? That person has to be your qualifying relative if they are not your qualifying child. And they cannot be your qualifying relative if they are your qualifying child or anyone else's qualifying child. So they have to be related to you, or they have to have lived with you the entire year, and they cannot be the qualifying child of anyone else. Then we move over to the next rule. You must also have provided over half the support for this person during the year. But of course, if the child is a qualifying child and you are divorced or separated parents, then that is not necessary for you to provide more than half support as long as both parents together provided more than half. Also, we have support claimed under a multiple support agreement. What happens then? If you didn't pay more than half, but people involved in a multiple support agreement did pay more than half combined. If you are considered to have provided more than half of the qualifying relative support under a multiple support agreement, you can include medical expenses you paid for that person. A multiple support agreement is used when two or more people provide more than a half of a person's support, but no one alone provides more than half. Any medical expenses paid by others who joined you in the agreement cannot be included as medical expenses by anyone. However, you can include the entire unreimbursed amount you paid for medical expenses. So let's look, for example, we've got mom. She's widowed, she lives in her own house, and she's got Social Security income of $5,000 a year. And there's the two children who are helping to support her because she couldn't make it without their help. Well, there's a number of tests we have to look at. And in this test, we've got mom who's providing some of her support, and we've got two children who are each also providing support towards her. And let's suppose that the two children between themselves provide more than half of her support, but neither of them alone does. Between those two children, they're going to have to agree on which one can claim mom. Whoever is in agreement, and they have to agree, because if no one agrees, no one gets her. But let's just say we've got Jack and Joe who are both supporting mom, and it is agreed that Jack will claim mom. Jack will be able to claim all of the medical expenses Jack paid for mom, but no one will be able to claim any of the medical expenses that Joe paid for mom. So that's what this multiple support agreement is saying. And finally, we have decedent. If you paid medical expenses for your deceased spouse or dependent, include them as a medical expense on your Schedule A, Form 1040, in the year paid, whether they are paid before or after the decedent's death. The expenses can be included if the person was your dependent or spouse or dependent at the time the medical services were provided or at the time you paid the expenses. So again, you're looking at whether or not you can claim medical expenses you paid for someone. Was that person your spouse at the time the expenses were incurred or at the time you paid them? And then if this person, of course, has died, were they either your spouse or your dependent at the time that either the expenses were paid or at the time they died? So we've looked at the types of people that you were allowed to claim medical expenses you paid for. Now let's look at the categories or types of expenses you might have paid to determine whether or not it's an allowable expense. Allowable expenses must be primarily to alleviate or prevent physical or mental defect or illness, such as payments for legal medical service rendered by physicians, surgeons, dentists, and other medical practitioners, and costs of equipment, supplies, and diagnostic devices needed for those purposes. Expenses that are merely beneficial to general overall health, such as vitamins or a vacation, may not be deducted. Now, I've been a mom for a while now, and because of the nature of the work that I'm in, it's difficult to work tax season, and my husband and I both work tax season together. So with two young kids at home, early on we decided to get au pairs and bring them in from Europe. We've had a lot of them. And one of the things that happens in Europe, especially if you're from Germany, but I think they have it in France too, is the national health coverage in those countries will send you to resorts for your overall health. And it's a concept that I'm sure most Americans cannot contemplate, that our government would pay for us to go sit around some resort and relax and recover our health. At any rate, it's a foreign concept that our government would pay that expense for us, and it's also a foreign concept that we could pay that type of expense and claim it as a medical expense deduction. So I just thought that was a cute point to throw at you. So as a general rule of thumb, you can claim a medical expense if the treatment is prescribed by a doctor to address a medical need, the treatment is related to your health or a diagnosed medical condition, the treatment is not purely cosmetic and holds a valid medical benefit. For example, eye laser surgery corrects myopia and is allowed, but a facelift for purely cosmetic reasons or teeth whitening is not allowable, even though medical practitioners carry them out. The treatment cannot violate the law. The expense is for equipment or home improvements needed to accommodate a medical need. Also, health-related programs such as alcohol and drug treatment centers or stop smoking programs are allowed, and you may also deduct costs associated with participating in a weight loss program. However, the cost of purchasing diet foods through a program is not deductible. The cost of attending Weight Watchers or another weight loss program is deductible. The cost of food you must pay to attend Jenny Craig is not. So IRS says anything that you're normally going to have to consume for your overall welfare is never going to be allowed as an expense to deduct on your return. And we all have to eat, even if we're on a diet. So Jenny Craig food is not going to be allowed. But of course, part of what you pay at Jenny Craig, I think, is a smaller monthly fee where you go in for counseling and so forth. And that would be allowed. Insurance premiums. Medical insurance premiums, including premiums paid with after-tax dollars that cover hospital care, surgery, etc., prescription drugs, dental care, contact lenses and glasses, group or co-op care, long-term care, or Medicare B and Medicare D are allowable as deductions. But if you have self-employed health insurance premiums, I already said it earlier, it's possible that you may qualify to claim these as an above-the-line deduction. And clearly an above-the-line deduction on the front of 1040 is the way to go if you can do it. Not only do you get the full expense, but also it reduces your adjusted gross income and open you up to other tax benefits that might have been phasing out when your income is going higher. One of which would be the ability to deduct any other medical expenses you have. So if you paid $10,000 of medical expenses or medical insurance premiums during the year, and you're able to reduce your adjusted gross income by $10,000, that would reduce the phase out by $750, wouldn't it? So it's always best to put it there if you can, but clearly you can't do it in both places. There is also a kind of health insurance premium that people pay. It's increasingly common, I have observed as a tax professional, and that is long-term care insurance premiums. The people that I notice are buying these tend to be single people in their 40s and 50s, no kids. They're the ones that are gravitating towards it because they know they're not going to have a spouse or children to take care of them when they get old. So they're thinking ahead, planning for a future where they might need nursing home care. But I do see some married couples with children who are paying for it. It's just been my observation that the people gravitating towards it in the biggest numbers are single folks with no kids. At any rate, this type of medical insurance premium is essentially advanced planning for that day when it comes that a person might need to be put into a nursing home and need that specialized nursing care. Most general health insurance plans do not cover that, or if they do, they cover only 30 days of it. And so people are looking forward to that time where it's possible that they would need it. It's incredibly expensive. If you're doing tax returns for people who are paying for nursing home care, it's not uncommon for that nursing home care to run $4,000 in a month. And so insurance premiums are intended to take a bite out of that. But to be deductible as a medical expense on Schedule A, the long-term care insurance premium has to be under a contract that meets certain conditions. Among those rules are that the contract has to be renewable. It cannot provide for cash surrender value or other money that can be paid, assigned, pledged, or borrowed. It must provide that refunds other than refunds on the death of the insured or complete surrender or cancellation of the contract and dividends under the contract must be used only to reduce future premiums or to increase future benefits, and generally not pay or reimburse expenses incurred for services or items that would be reimbursed under Medicare, except where Medicare is a secondary payer or the contract makes per diem or other periodic payments without regard to the expense. The amount you can deduct for a qualified long-term care contract depends on your age at the end of 2011. So let's take a look at what those rules are. I have a table here and it's bumped on me. I do these documents in Word, and Word has an annoying habit of moving something on me after I placed it. So this table right here should be above meals and lodging. It is not a part of meals and lodging. So this table here refers to the age under which a contract can be deductible and the maximum amount of insurance premium paid during the year that will qualify as a deduction. So if you are age 40 or under and you're paying for long-term care insurance premiums, the maximum amount you are allowed to deduct for those premiums during the year is $340. And you will see as you age, the maximum amount you can deduct goes up, $640 if you're between 41 and 50. If you are 51 to 60, you can deduct $1,200. If you're 61 to 70, $3,390. And if you're age 71 or older, they're allowing you to deduct $4,240. Another deductible item is meals and lodging, and whether or not the meals or lodging is deductible, it depends on how or why the expense is being paid and also where it is being paid. Firstly, a place that you might be paying for meals and lodging is at a hospital. And you may deduct the cost of meals and lodging at a hospital or similar institution if your main reason for being there is to receive medical care. If you're not at a hospital, you may deduct the cost of lodging while away from home, even though you're not staying at a hospital or similar institution, provided all of the following are true. Number one, the lodging is primarily for and essential to medical care. The facility is related to or the equivalent of a licensed hospital. The lodging is not lavish or extravagant. There is no significant element of personal pleasure. And get this, the cost of lodging cannot exceed $50 per person per night. How $50 per person per night could possibly be seen as extravagant or lavish, I don't know. But you are limited to $50 per person per night. You may not deduct the cost of meals unless you are at a hospital. Now, nursing home or home for the aged. Expenses are allowable for you, your spouse, or your dependents, including the cost of meals and lodging, provided you are there for medical or nursing care reasons. So when you're at a nursing home, there's different classes of nursing homes. And I've spent some time looking at these, trying to make sure I'm clear on what the IRS allows and doesn't allow. But they seem to be pretty generous. You go into a nursing home, and in some nursing homes, you're given a small room, and you're in a hospital bed, and you've got attendees all the time who roll you around in a wheelchair. That would be the most extreme. But many people in their elder years move into assisted living centers. And some of the assisted living center residences are full-scale apartments with kitchens and 2 bedrooms and a living room and a bathroom. And they may live in the assisted living center without really getting any assistance. They're just there. They wanted to move in and be around people their own age so that when the time comes, maybe they can start to get that assistance. So you do have to be careful when you're looking at these individuals to determine whether or not they're in the center to receive medical care, or whether they're just there because they want to be there. And there is a line that does eventually get crossed where they move from being in the center without much assistance to actually needing assistance a great deal of the time. And so one of the things I do is I pick up the phone and I call the center and I say, okay, you've got this particular resident living in your center. Can you please tell me what portion of the amount that they're paying you is just rent and lodging, and what portion of what they're paying you is for care? But even that becomes unnecessary at a certain point, because once the primary reason for being there is care, it's all deductible. So they're either in a situation where very little is deductible, or they're in a situation typically where it's all deductible, is what I'm finding. Transportation. You can claim a deduction for transportation costs associated with a medical need. Allowable transportation expenses can include bus, taxi, train, airfare, or ambulance. Transportation expenses of a parent who needs to accompany a child who needs medical care. Transportation expenses of a nurse or another person who must accompany a person to provide medical treatment when that person is unable to do so alone. And transportation expenses to visit a mentally ill dependent if those visits are prescribed as a part of the patient's treatment. Transportation expenses not allowed include commute to and from work and transportation for non-medical reasons. For example, you travel to Hawaii for medical treatment available to you in your hometown. Not going to be able to claim that trip to Hawaii as medical when you could get it right where you live, sorry. Car expenses. You can claim a standard rate of 19 cents per mile driven prior to July 1, 2011, and 23.5 cents per mile for mileage driven after June 30, 2011, or you can claim the actual cost of gas and oil, but there is no allowance for depreciation or maintenance. No. General overall welfare, benefit of health, exercise, health gym club memberships, absolutely not allowed. Disabled dependent care expenses. You may be able to claim certain disabled dependent care expenses as a medical deduction or as a dependent care benefit, a dependent care credit rather. Either is allowable, but remember, you cannot double deduct by claiming both a deduction and a credit for the same expense. You can claim either the deduction or the credit, but not both. So let's think of an example of how this might happen. And this one has got kind of a pretty specific rule around it. This course is about medical expenses and not about the dependent care credit. But I feel I should maybe mention some of the rules around the dependent care credit. It's actually called the Child and Dependent Care Credit, and most of us have experience dealing with the Child and Dependent Care Credit when we have clients who pay child care so that they can go to work. There is a secondary side of that credit, which is the dependent care credit, and you move over into the category of dependent care credit when you have a person who is a dependent but is not meeting the definition of child. And for purposes of child and dependent care credit, you have to pay child care expenses for a child who is under age 13 or a dependent who is unable to care for themselves. Now, you could have an autistic child who is 17 years old that you cannot leave alone in the house. And that would be a good description of a dependent that would qualify for the dependent care credit. So you might have a child who is age 13 or older who is incapable of self-care, so you're bringing care in to take care of that person. That type of care would also qualify as a medical expense. So IRS is saying you can claim a dependent care benefit if you qualify for it, and you could claim it as a credit, but you cannot use the same expense to claim the credit that you then turn around and claim as an itemized deduction. Capital expenses. You can deduct the amounts you pay for special equipment installed in a home or for improvements if the main purpose is medical care for you, your spouse, or your dependent as follows. If the cost of a permanent improvement increases the value of the property, you may deduct the cost of the expense that exceeds the increase in the value of the property. If the value of your property is not increased by the improvement, the entire cost is included as a medical expense. Examples of the types of improvements that do not normally increase the value of property include constructing entrance or exit ramps to your home. In fact, those would normally make the property value drop. Widening doorways at entrances or exits to your home. Widening or otherwise modifying hallways and interior doorways. Installing railings, support bars, or other modifications to bathrooms. Lowering or modifying kitchen cabinets and equipment. Moving or modifying electrical outlets and fixtures. Installing porch lifts and other forms of lifts, but elevators, by contrast, do generally add some value to the house. Modifying fire alarms, smoke detectors, and other warning systems. Modifying stairways. Adding handrails or grab bars anywhere, whether or not they're in the bathroom. Modifying hardware on doors. Modifying areas in front of entrance and exit doorways, or grading the ground to provide access to the residence. Note, however, that additional capital costs paid for personal motives, such as for architectural or aesthetic reasons, are not medical expenses. The IRS has a very short worksheet here, 5 lines long, to help you establish how much of a deduction you can claim if you made a capital improvement to the house. It isn't hard to predict how this worksheet will work. You begin by entering the amount that you paid for the home improvement. You then enter the fair market value of your home before the improvement and the fair market value of your home immediately after the improvement. If there's a change in the fair market value of the home and it goes up, however much it went up by is going to reduce the amount of allowable expense. So it says subtract line 3 from line 2. If 4 is more than or equal to 1, you have no medical expenses due to the home improvement. Stop here. And subtract 4 from line 1. These are your medical expenses due to the home improvement. Operation and upkeep. You can deduct costs you paid for upkeep of property that accommodates a medical need, even if the cost of the property was not deductible because it improved the value of your home. And here's an example. You install an elevator in your home because you are unable to climb stairs. The cost of installing the elevator is $8,000, but the value of your home also increased by $8,000 when you installed the elevator, so you couldn't deduct the cost of it. However, the cost of electricity to operate the elevator and any cost to maintain it are medical expenses as long as the medical reason for the elevator exists. So that's kind of interesting.
Session 8 password number 2 is Bronco, B-R-O-N-C-O.
Allowable medical expenses. What I've done for you here is I've gone into IRS publication 502. 502 is a publication totally devoted to medical, and I'm definitely not covering everything that's in that publication today. I just went into it and pulled out the most important stuff that I felt you needed to know. But among the things that are in it is a list of, it basically goes on and on and on, page after page, of the types of expenses that are deductible, and then it goes on to other expenses that are not deductible. And most of the items that I have listed for you here on this page are pulled from that publication in the order in which they appear in the publication. But what I've done is I've taken out the paragraphical descriptions, and I've just put them into bullet points. So if you want to know more about any of these paragraphical descriptions and in terms of the limits that might apply, you would need to go to publication 502. For today, I'm just going to blaze through them so that you kind of have an impression, a mental impression in your mind in case a client brings it up. The first one is alcohol addiction treatment, including Alcoholics Anonymous meeting attendance. That's not to say only alcohol attendance, Alcohol Anonymous attendance. It could include any kind of alcohol addiction treatment that you are being given, but a normal recommendation that a physician will give to a patient who is an alcoholic is to attend AA. And for that reason, if you've received that recommendation from your physician, then attendance at AA would be deductible, and that would be the fees you pay to get into the AA meeting as well as the transportation to and from it. Ambulance, annual physical examination, the cost of artificial limbs, artificial teeth, auto-et, bandages, birth control pills, body scan, braille books and magazine, to the extent the cost of these items exceeds the cost of a regular book. Breast pumps and supplies, breast reconstruction surgery. Car, medical improvements and medical use operating costs of the car are allowed. Chiropractor, Christian Science practitioner, contact lenses, crutches, dental treatment, diagnostic devices such as blood sugar test kits, disabled dependent care expenses, drug addiction treatment, drugs, eye exam, eyeglasses, eye surgery, fertility enhancement, and surgery. Also, a founder's fee, guide dog or other service animal, the cost of purchase and care of that animal. There is a guide horse. Did you know that? There's people who have taken miniature horses and trained them to be guide animals. It's the most fascinating thing, and apparently they're pretty good at it. And their little miniature horses are tiny little things. But I would have one of those. Okay, Health Institute, prescribed by physician for necessary treatment. Health Maintenance Organization, hearing aids, home care, home improvements. See the capital expense rules I talked about earlier. Hospital services, insurance premiums, hospitalization, surgical services and x-rays, prescription drugs and insulin, dental care, replacement of lost or damaged contact lenses, and long-term care subject to additional limitations. Medicare B, Medicare D, prepaid insurance premiums, but restrictions apply. Intellectually and developmentally disabled person, that would be any expenses you pay for the special home care needs of that intellectually or developmentally disabled person. Laboratory fees, lactation expenses, lead-based paint removal, legal fees paid to authorize treatment for mental illness, lifetime care, advance payments allocable to medical care. Dependents with disabilities. This is one where I actually took the whole paragraph because it's kind of important. You can include in medical expenses advance payments to a private institution for the lifetime care, treatment, and training of your physically or mentally impaired child upon your death or when you become unable to provide care. The payments must be a condition for the institution's future acceptance of your child and must not be refundable. Lodging, as described earlier, long-term care services and insurance premiums, meals, see the rules I described earlier, medical information plan. Medicines must be by prescription only, the sole exception being insulin. You do not need a prescription for insulin. Nursing home, including meals if the reason is medical care, nursing services or similar services, and what IRS means by this is you could pay for the services of a nurse, but you could also pay for nursing services from someone who is not a nurse, and that's okay. Operations except for cosmetic, optometrist, organ donors, osteopath, oxygen, physical examination by a physician, prescription drugs purchased and consumed in another country if the drug is legal in both the other country and the United States, and you'll have to notice it says prescription drug purchased and then consumed in the other country, legally. Pregnancy test kit, prosthesis, psychiatric care, psychoanalyst, psychologist, special education. You can include in medical expenses fees you pay on a doctor's recommendation for a child's tutoring by a teacher who is specially trained and qualified to work with children who have learning disabilities caused by a mental or physical impairment, including nervous system disorders. This is, I think, a really important one to be on the ball with, and a question I frequently ask my clients is, do you have a child who is disabled? Not all parents are willing to admit that they have a child who is disabled. They may not even be willing to admit it to themselves. but some parents are really on the ball. They figured out pretty early on that their child has autism, and they're dealing with it. And there's a lot of autistic kids out there. We hear it all the time. So if we hear about autism on the news a lot, we should be looking for clients who possibly have autistic children. And of course, there's the obvious ones like deafness and blindness, but autism is what I would say is by far the most common. But you may also have ADD or some other medical condition that makes it extremely difficult for that child to learn in school. And so the physician could say, I recommend you put your child with a specialized tutor with training on how to help your child learn. And what the IRS is saying is if that happens and you have that kind of an expense, even though it is tutoring, it would be deductible. But it has to be on a doctor's recommendation, and your child has to have a physical condition that makes it difficult for them to learn so that they require these specialized services. Teaching Braille to a visually impaired person, teaching lip reading to a hearing impaired person, giving remedial language training to correct a condition caused by a birth defect, sterilization, stop smoking programs, surgery, telephone devices for hearing impaired, and television devices for the hearing impaired, therapy, transplant costs, including payments to a donor, transportation, but see earlier, trips when necessary for medical treatment, tuition if special education required to address a medical condition, vasectomy, vision correction surgery, weight loss program, but of course see earlier about the rules for that, wheelchair, wig on a physician's advice for a patient who loses hair from disease, and x-ray. So that's a long list of the things the IRS does allow, and what often throws my customers for a spin is, so how much is deductible? That many of my customers expect, well, yeah, health insurance should be deductible, but you mean my dentist is? You mean my contacts are? What about the chiropractor? Yes. So when I ask my clients, what medical did you have? It's kind of a short-ended question. They might say, oh, none. Well, no one has none. So I start listing, okay, no chiropractor, no dentist, no optometrist, nothing. And usually one of those things, oh, what? I can claim chiropractor? Yes, you can. So what expenses are not allowable? The following is a list of some items you cannot include in figuring your medical expense deduction. Babysitting, childcare, and nursing services for a normal, healthy baby. Now, of course, you might qualify to claim a child care credit to enable yourself to go to work when you pay for child care, which is also a form of babysitting. However, we're talking about medical here, and you can't claim a medical deduction for babysitting services for a healthy baby. Also, controlled substances, not deductible. Cosmetic surgery. Generally, you cannot include in medical expenses the amount you pay for unnecessary cosmetic surgery. This includes any procedure that is directed at improving the patient's appearance and does not meaningfully promote the proper function of the body or prevent or treat illness or disease. You generally cannot include in medical expenses the amount you pay for procedures such as facelifts, hair transplants, hair removal, electrolysis, and liposuction. You can include in medical expenses the amount you pay for cosmetic surgery if it is necessary to improve a deformity arising from or directly related to a congenital abnormality, a personal injury resulting from an accident or trauma, or a disfiguring disease. So there are some situations where cosmetic surgery is allowed, but you're really going to have to show that a physician recommended it to address a medical need of the patient, and that there was a medical benefit that came to the patient from it, and not just, oh, I look skinnier, or I look prettier, or I look better in some way. We could all, of course, argue that we're more mentally healthy when we look better, but the IRS is not looking at that. Here is an example. An individual undergoes surgery that removes a breast as a part of the treatment for cancer. She pays a surgeon to reconstruct the breast. The surgery to reconstruct the breast corrects a deformity directly related to the disease, and the cost of the surgery is includable in her medical expenses. Diaper service is not allowed, except where the diapers are required due to effects of disease. So you have a normal baby who wears diapers, clearly you're not going to be able to claim that. But if you have an older person or even an older child who, for medical reasons, can't control themselves, then the diaper would be allowed. Electrolysis or hair removal is not allowed. Funeral expenses not allowed. future medical care, not allowed, hair transplant, not allowed, health club dues, household help, illegal operations and treatments, maternity clothes, medicines and drugs purchased from other countries, prescriptions brought into or ordered and shipped to the United States from another country. You can only include the cost of a drug that was imported legally. For example, you can include the cost of a prescribed drug that the Food and Drug Administration announces can be legally imported by individuals. Well, I tried to find out if there was any such thing, and all FDA had on its website is all the reasons why buying from Canada is a bad idea, because there's all these fake websites being set up where the drugs aren't actually coming from Canada. And that was the caution. So lots of people buy from Canada, but if they do, they can't deduct it. Non-prescription drugs and medicines except for insulin, and nutritional supplements. You cannot include in medical expenses the cost of nutritional supplements, vitamins, herbal supplements, natural medicines, etc., unless they are recommended by a medical practitioner. The only place that you're allowed to claim these items is if they are prescribed. And the way I'm reading this is if you're at your doctor's office and he hands you the medication and charges you for it directly, maybe. But if you go into the store because your doctor said, I want you to buy this vitamin, it's not going to fly. There's a comment in the classroom, but I went to the doctor and she gave me a prescription for these vitamins I need for my illness, and you're telling me I can't deduct them. I'm telling you what the IRS publication says. It says you have to have a prescription and it has to be filled. So this paragraph here is saying you cannot include the cost of nutritional supplements, natural medicines, etc., unless they are recommended by a medical practitioner. On another paragraph, it's telling you that you cannot claim over-the-counter drugs, and it's telling you you can't claim vitamins. So I think that they're looking at a very probably narrow definition here that says if you go to the doctor and the doctor recommends it, you might be able to, I would be very skeptical. My answer would be if you're in an audit, the auditor probably will not give it to you. One of the things that we do look at is recently there was a change in how you were allowed to spend money from a medical savings account, what is a permitted distribution from that medical savings account. And the rule had previously been you could use money from an MSA or HSA to purchase over-the-counter drugs. The rule has been changed and you're no longer allowed to do that. That a qualifying distribution from an HSA includes only prescription drugs purchased from a pharmacy. So they have to be by prescription. It could be an over-the-counter type of drug that you could buy over-the-counter, but they're going to have a pharmacy fill it. So how do I claim a medical deduction? Well, I claim it on Schedule A, and I make entries on lines 1 through 4 to do so. Line 1 says, how much did you spend on allowable medical expenses? Enter that number on line 1. And then on line 2, it says enter the number or amount from 1040 line 38. That is your adjusted gross income. So enter your adjusted gross income on line 2. Then multiply line 2 by 7.5%. And then the difference between the number you enter on line 3 and the number you have on line 1 carries over to line 4 and is the deductible amount. Now, for those of you who deal with clients who pay alternative minimum tax, you should know that under alternative minimum tax, the limit is 10%.
And it is now time to complete the Session 8 classwork assignment. This is one of the easier assignments we're giving you in this series. Always thankful when we give you something easy, hey? And this is simply a 4-question classwork assignment. Determine which of the following may claim a medical deduction. Your job is to read through each of the scenarios and establish which of these filers can claim a medical deduction and which of them cannot. I will do the first one with you, and then you can finish the others on your own. Number 1, Mary is the non-custodial parent of Jeffrey. Jeffrey qualifies as a dependent and is in the custody of one or both parents for more than half the year. Mary paid a $500 medical bill for Jeffrey. Can Mary claim a medical deduction for this expense? Well, the answer is yes. The answer is yes, because even though Mary is not the custodial parent, the child is in the custody of one or both parents and will be claimed as a dependent on one of the parents' tax return. Therefore, even though Mary can't claim his exemption, she will still be allowed to claim a deduction for the contribution or the expenses that she paid for him.
So at this point, please push pause on video playback, complete questions 2 through 4. When you are finished, resume video playback for a review of the answer key. And I have the answer key for classwork assignment for session 8 up on the screen in front of you now. And one of the things I wanted to point out is that the answer key does reference where you should be reading in Pub 17. So for example, for classwork assignment question number 1, I said yes, Mary can claim a deduction for the medical expenses she pays for her child. And the place to reference that would be IRS publication, page 145, Child of Divorced or Separated Parents. Let's look back in the manual now. We're on page 35 of the manual. Mr. and Mrs. H incurred medical bills for their dependent child who died during 2011. Mr. and Mrs. H paid the bills during 2011. Mr. and Mrs. H can claim a deduction for this expense. Well, the answer to the question is yes, you can claim expenses you paid for your deceased dependent or spouse during the year they died or after the year they died. Expenses are claimed on the return for the year that they are paid. And for that, please reference Pub 17, page 145, what if you pay medical expenses of a deceased spouse or dependent? Line 3. Jane incurred a medical bill in April of 2011. In October, she married John. John paid Jane's medical bill for her in November. Jane and John will file separately. Who can claim the medical deduction on their return? Well, the answer is John can claim the expense because he paid the medical bill after they were married. She cannot claim it. Jane cannot claim it because she didn't pay it. The medical expense can only be claimed by the person who actually paid it, and it was John. You should refer to publication 17, page 144. Whose medical expenses can you include? And then finally, question number 4, assume the same as question 3, except John paid Jane's medical bill in June. Well, that creates a problem because they were married in October. And if a medical bill is paid for a period of time when you were not married, you cannot claim it unless you file a joint return. And in this case, if they file separately, John cannot claim it, and ultimately Jane cannot claim it either. So the answer is, for number 4, nobody gets it. Jane did not pay the bill, so she cannot claim the expense, and since John paid the bill before they were married, he can claim the expense only on a joint return. That concludes the review of the Session 8 classwork answer key. So here we are on to the next topic of the day, which is deductible taxes, and you can claim a deduction for certain taxes you pay on Schedule A, and if you do so, you report them on lines 5 through 9. For a tax to be deductible, it has to meet 2 important tests. The first one is the tax has to have been imposed upon you. You have to be the one legally responsible for that tax, paying it. And secondly, the tax must have been paid by you during the year. So if someone else pays your debt for you, you can't deduct it. And if you pay a debt for someone else, you can't deduct it. It has to be imposed upon you, and it must also be paid by you. So what does imposed upon you mean? It means it must be imposed on your income or on property that you own. Taxes you pay on property you do not own are generally not deductible. Now, I run across this particular one all the time. We've got children who pay taxes on their parents' house for their parents because their parents can't afford it. Or they have a brother who can't afford to pay his property taxes because he's been unemployed for the last year, and so they help their brother out by paying his taxes for him. That's not a deductible expense because you're not legally responsible for that debt. You don't own the property on which that tax is being assessed. So a smart thing to do would be to gift the money to the person who has that debt and let that person pay that debt directly, and then that person would be able to claim the deduction themselves. Next rule, it must be paid by you. Assuming you are a cash basis taxpayer, and nearly everybody is, you must pay the tax during the year for which you are filing. For example, if the tax is imposed on you in 2011, but you do not pay it until January of 2012, you cannot claim a deduction for it on your 2011 return. You will, however, be able to claim a deduction for it on your 2012 return. Now, one of the things I run across when my clients come in is they bring me their property tax statement. It's the bill that comes in the mail. And here in Portland, Oregon, that bill typically arrives in November. And it says, here's your tax bill for the year. That's just great. I can see that the tax was imposed on you. You've passed one of the two tests. Now let's see the second test. Did you pay the test? Well, there's two places to go to figure out if they paid the tax. One is the mortgage interest statement, the 1098 they get from the bank. Sometimes that will show that taxes went through escrow and were paid out. But sometimes it's blank, especially if they're free and clear and don't even have a mortgage. But sometimes it's blank because they're not paying their taxes through escrow. And sometimes even when they are paying them through escrow, it's not showing on the statement. And one year, I had a client who it didn't show on the statement. And when we investigated, we found out that the bank that had held the money had dropped the ball and not paid the tax at all. So that was a bad deal. Couldn't claim a deduction, but he did get to scream at the mortgage company that had dropped the ball. So my job as a tax preparer is to ensure that both the tests are passed. My client brings me the bill that's evidence that the tax was assessed upon them. I need to know that they actually paid it. Now, in some states, you can actually log on online to the county and look up a physical property address and see tax assessments, the owners of the property, and whether or not the bill has been paid and the date it was paid. Washington State is one such state. It's just super fantastic. My client hasn't got a clue in the world as to whether their taxes were paid or how much or when, and I just log online to the county website and look it up. Now, other states like Oregon don't do it that way. You can look up who owns the property. You can look up how much the tax on the property is, but they don't provide information about whether or not it was paid. And so here in Oregon, the only way we can find that out is to call the county during normal office hours and talk to a person who will look it up and tell us. And so I have basically speed dial in my phone for that function because I probably call the county weekly throughout the tax season for one client or another to establish whether or not taxes were paid. And here's the deal. My client comes in and says, well, here's my property tax statement. And I say, that's just great. I can see the tax was assessed on you. When did you pay it? I don't know. I don't have that checkbook with me. You know, that was several months ago. Okay, well, do you think you could find it? Well, I don't know if I saved that. We could look it up online. Yeah, but I'm not sure the date, the month, the amount. Well, we know the amount that it should have been because it's on the assessment statement, but maybe you paid it in thirds, so it's not exactly matching the assessment anyway. So those are real common conversations I have, which often causes me to pick up the phone. And when I pick up the phone and call the county, I get answers like, well, they made one payment in February for $982.13. They made another payment in May for $22.82. They made a third payment in September for $2,013. Oh, and then in November they paid $3,000. I get answers like that. So then, of course, we have to determine what portion of each payment was interest and how much, because when you're paying your taxes late, typically there is interest, and then what portion was actual tax payment. So that's just a procedure I go through on a regular basis for my clients to ensure I am putting the correct number on their return. Okay, so let's take a look now at deductible taxes. We've been talking about the debt must be imposed upon you and you must have paid it, and I was just giving an example of how it can be tricky sometimes to figure out how much and when a tax was paid. But we're going to move on now to a discussion of income taxes. You may deduct the following income taxes that you paid. State and local income taxes withheld from your wages during the year. State and local estimated taxes paid during the year can be deducted if you reasonably believed you needed to make the payments. You can deduct the amount of a refund of state tax you choose to have credited to the next year's estimated taxes. And you can deduct any balance due income tax payments you paid to state or local governments during the year. For example, you made a $3,000 estimated tax payment in your state on January of 2012 for your 2011 state tax return, even though you knew this would result in an overpayment of tax to your state. When you file your state return in April 2012, you receive a refund of $4,000. In this situation, you will not be allowed to claim a deduction for that estimated payment that you make of $3,000 And you won't be able to claim it on your federal 11 return or your 12 return because you didn't reasonably believe you would owe it. You paid it only to probably deduct it, and that's not a valid reason for claiming the deduction. Example number 2, you elected to apply $500 of your refund from your 2011 state return towards 2012 estimated taxes. Include this $500 payment as an itemized deduction on Schedule A for your 2012 federal return. Number 3, you file your 2010 state return in April of 2011, and you had a balance due of $500, and you paid the balance due before the end of 2011. You will be allowed to claim a Schedule A deduction for that $500 of tax paid when you file your 2011 return. These are kind of self-evident things, but they're also things that I see a lot of tax practitioners don't bother with. One of the first things I do when I have a client come in that's new to me is I look at last year's tax return and I look at last year's state tax return to see what the balance due was, and then I say, did you pay the balance due? And if they did, then I put it on their Schedule A as a deduction. But it requires a little bit of work to actually think about it, open up the return, analyze it, and do that. I see a couple of questions in the board in front of me. Kate 2 is saying, back to question number 3, we're looking at the questions that we had on our classwork earlier. What if the medical was paid by John out of a joint checking account for him to take? He must have a separate checking account, correct? There is an issue that the IRS gets into with joint checking accounts. If a bill is paid from a joint checking account, they assume that the deduction should be split equally unless you have evidence to show otherwise. That's in the 502 publication. I read it yesterday. Not something I taught in today's class, though. All right, and then refund of taxes. Do not reduce the amount of your income tax deduction by refunds you received during the year. However, if you received a refund of taxes paid in a prior year, you should first establish if you benefited by claiming those taxes as a deduction in the prior year. If you received a tax benefit, the refund must be included as income. You benefited if deducting the state taxes reduced your liability, your federal liability, in that earlier year. For example, you did not itemize in 2010. You received a state income tax refund of $400 on your 2010 state income tax return during 2011. Because you did not receive a tax benefit from deducting the taxes from your federal income, you do not need to report the 2010 state refund in your income. Now, many states issued a document called a 1099-G. The 1099-G reports a refund. Now, some states issue 1099-Gs no matter what the size of the refund is or whether or not a person itemized, and some states issue them or try to issue them only when there is an indication that the refund might possibly be taxable. But either way, it's the tax preparer's job to establish whether or not the income reported on the 1099-G is in fact taxable. And sometimes it's not. Often it's not. The first test I look to is, did they itemize in the year to which the refund applies? So I'm holding a 1099-G, and it shows that there was a refund issued on my client's state 2010 tax return. Okay, the 2010 return would have been filed in 11. I'm preparing an 11 return. There was a refund. It was received. Do I just stick it on the tax return I'm preparing as income, or do I think through and establish whether or not it's actually taxable at all? And to do that, I need to look at the last year's 2010 federal tax return. Starting point, did they itemize? If they didn't itemize, automatically the refund's not taxable. Now, let's suppose they did itemize. If they itemized, but the refund doesn't benefit them, it's still not taxable. So how would I establish whether there was a tax benefit from claiming tax as a deduction? Well, the most obvious thing for me is, well, if I threw out all the state income taxes that were deducted, would their refund or balance due for the earlier year change? That's the test I look at. So I itemize, I claim all these deductions, but if I take off the state income tax deduction and don't claim it, does anything change balance due-wise, tax liability-wise? Now, the IRS provides a worksheet for figuring the taxability of a state refund, but I think it's full of holes. The only thing it looks at is how much your itemized deductions exceeded the standard deduction in the year before. And I'm going to show you that. But it's possible to not benefit even though you did itemize from a state tax deduction. For example, we've got Jane who's filing head of household, and she has income of $40,000, and she's got 4 kids at home, and she's qualifying for an education credit and a bunch of other stuff. Whether she itemizes or claims a standard deduction probably would make no difference. By the time she's run through all of those tax benefits, she's probably going to get her tax down to 0 anyway. And if she chooses to itemize, she could definitely have itemized deductions that exceed her standard deduction, but does it matter that she itemized? Could we throw out those itemized deductions completely and arrive at the same overall tax for the year? And that's entirely possible. So I'm going to show you the worksheet, but my caution is you can think beyond the worksheet, because the IRS says the rule is it's includable in income if there was a tax benefit. You have a tax benefit if it reduced your tax in the earlier year. How do you establish that a tax benefit was received in the earlier year? Take the deduction out of the earlier year return, compute tax for the earlier year without that deduction, and see if anything changes. And if nothing changes, there is no tax benefit. So let's look at some more examples here. Number 2, you did itemize your deductions in 2010. You received a full tax benefit from claiming your 2010 state income taxes as an itemized deduction on your federal return, and you must include that $400 state refund in your income for 2011. And you would report it on line 10 of your Form 1040 for 2011. Example number 3, you did itemize in 2010, but you received only a partial benefit from claiming your state income tax as an itemized deduction. You must determine what portion of state income taxes paid actually benefited you when you claimed them as a deduction on your Schedule A. You include the amount that benefited you as income on your Form 1040. And here's an illustration. In April of 2011, you file your joint 2010 return, and you itemized your deductions and claimed the following expenses: charity of $1,000, state income taxes paid of $2,000, mortgage interest of $7,500, and real estate taxes of $1,100. When you add all of those deductions up, you get $11,600, but the standard deduction in the earlier year was $11,400. So you itemized, but just barely. The difference between the standard deduction and itemized deductions is $200. So even though you received a refund of $1,000 from the state, only $200 is going to get taxed. The IRS, as I said, has a worksheet. They call it the State and Local Income Tax Refund Worksheet. And the worksheet essentially says, what was the refund reported on the 1099-G? What were your itemized deductions in the earlier year? What was your standard deduction for the earlier year? Subtract the standard from the itemized and enter the difference. And in this case, the difference is $200, and that's the amount that's taxable. Foreign income taxes. You can claim an itemized deduction for foreign income taxes paid on income that is not exempt from U.S. tax because you claimed the foreign earned income or foreign housing exclusion. You may be able to claim the foreign tax credit also, but you may not claim a foreign tax credit and itemize your deductions for the same foreign tax at the same time. Remember, no double deductions. Even if you did not work overseas, you may have paid foreign income taxes if you owned foreign securities through direct stock ownership or through a mutual fund. So I look for foreign taxes on all kinds of statements, especially brokerage account statements, 1099 DIV statements frequently have foreign taxes paid on them. Now, nearly always the client is going to be better off claiming the foreign tax credit, but it's possible it may just be easier or better to itemize the deduction, and it is allowed to claim the itemized deduction, but of course not the itemized deduction and the credit at the same time. Now we're on to a topic called optional deduction for sales taxes paid. The deduction for state and local income taxes originally expired for tax years after 2009. However, the Reed-McConnell Tax Relief, Unemployment Insurance Reauthorization and Job Creation Act, that's a mouthful, extends the deduction for 2 years through 2011. So for 2010 and 11, you continue to make an election to deduct income taxes or sales taxes as an itemized deduction. What this is saying is, unless there's legislation passed for 2012, this deduction is gone. So I'm about to teach you how to do a pretty complex worksheet. to figure the deduction for sales tax, and the deduction may be gone. So we'll see what our politicians do this year. Now, if you are going to claim a deduction for sales tax, you do so instead of income tax. If you elect to deduct income taxes on your tax return, you would check box A on line 5 of Schedule A and enter the amount of state and local income taxes you are deducting or that you paid on line 5 with the box A checked. But if you decide you want to deduct sales taxes, you're going to check box B on line 5 instead, and then you would apply either of these two methods to determine the amount of deduction that you are allowed to claim. The IRS allows you to figure your sales tax deduction in two different ways. Under method 1, you actually save all of your receipts. Imagine every time I go to the grocery store, every time I buy gas, every time I pay a bill, I'm looking for the sales tax that I paid, and I'm totaling it up. It would be an interesting exercise for a person who had time. Or alternatively, I can go for method number 2, which says I don't have to bother with any of that. I'm just going to go to these tables and find my number from the table and use that instead. So, of course, we're going to take a look at that. Okay, so the first thing that they have relating to the table is a chart, or a worksheet, rather. There's charts and worksheets, and the worksheet is where you go to put numbers that you get from the chart. So let's take a look at the charts first. Charts are in your manual. Boy, quite a few pages down. Here we go. Beginning on page 27. Now, some people live in a state with no sales tax. There's not many of you out there, but it happens to be my home state of Oregon, where I'm sitting today, has no sales tax. So this is not a deduction I claim very often. But we have a neighboring state, Washington State, right across the border from us, that does not have an income tax. They have only sales tax. So you could say we're rival states. One has only income tax, one has only sales tax. But most states have both. So in most states, you're going to be on an annual basis having to decide, is my client better off claiming the sales tax deduction or the income tax deduction? And the quick way to figure that out would be to go to the table and find your client's income. And here we can see it's got the income, and it says the first column is your income is at least this amount, but less than this amount. So you'll notice that $40,000 appears on 2 lines. If it appears on the top line, it means that your income is less than $40,000. And if it appears on the next line that says $40,000, it means your income is equal to or greater than $40,000, but less than $50,000. So we would follow that line across and say, okay, my income is $45,000 for the year, and I live in the state of Arizona, and I have a husband and 2 children, so I'm just going to follow this line across. Did I say my income was 55 or 45? I can't talk and think at the same time. I said my income's 55. Let's go with that. So we're going to go across the line and find Arizona and 4, because there's me and my husband and my 2 kids. And let's just zoom in on what this says. Arizona, 50 to 60, exemption number 4, and the answer would be 803. So the starting point for the workshop, or for the worksheet, is to find the number on the sheet based on the state that you are a resident of and the amount of dependents that you have and the amount of income that you have. And you're going to select that number. So that's how the worksheets work. And of course, there's a separate worksheet for every state with the exception of, well, Oregon. There's no Oregon on this worksheet. And then there underneath it on the next page, we have an optional local sales tax table. Most states that have sales tax also have local taxes. And some of the states that have local taxes have a worksheet that you go to or a table that you go to look up the local rate for that state. And you would find so for example, Colorado, it says if you live in Adams County, for example, then use local rate A. So then we'd go down to table A and find the number on table A based on the number of exemptions and your income. But not all states are listed and not all counties. Even if you have a state that's listed, not all counties are listed. For example, California lists only 1 county. So if you're in California from any other county, you don't use the secondary state table. So we're going to go back up and take a look at the worksheet and how to fill it out. To a certain extent, software will fill this worksheet out, but you still have to know what you're doing to make sure the software is filling it out correctly, because there are some optional entries. For example, if you live in a state where sales tax is normal and quite high, you might be triggering your software to always load this particular worksheet. But the software will not know all of the information that needs to go on it. You still need to be thinking through all of the processes necessary to get the numbers that go on here correct. So we're going to take it line by line. And the first line of the worksheet, this line right here, says enter your state general sales tax from the 2011 optional state and certain sales tax worksheet or table. That's the one I just showed you. So that's the starting point. Then it says, did you live in Alaska, Arizona, Arkansas, California, or a variety of other states or counties? If so, you're going to check yes, and then go to that third table and the worksheet for that table, or to find the amount that's shown there. Most people will check no. And for our illustrations today, we're going to check no and go through the extra work that it takes when you do check no. Did your locality impose a local general sales tax in 2011? Residents of California and Nevada see the instructions. If the answer is yes, enter your local general sales tax rate. Well, if that rate's not showing on a table, how would you know what it is? Well, you might be lucky enough to have software that if you type in a zip code, the software will know the rate and stick it in there for you. It might be that you go to the IRS website and look it up. It might be that you go to the local county website for the area that you live in and look it up. But at some point, it has to be determined what that local rate is. And then it says, did you enter 0 on line 2 above? If yes, enter your state general sales tax rate shown on the table. No, skip lines 4 and 5 and go to line 6. So let's just talk about what's happening on each of these lines. The first line says, find the state where you live in 2011 in the optional state and certain local sales tax tables. The table asks you to select the correct dollar amount using 2 pieces of information. One of them is the number of exemptions shown on your tax return, and the other is the income from line 38 of your Form 1040. But it's got additional amounts that you need to add to your income on 1040. So your AGI on line 38 is not the only amount you're allowed to consider. You are also allowed to consider tax-exempt interest that you received, VA benefits, non-taxable combat pay, workers' compensation, non-taxable Social Security and railroad retirement benefits, non-taxable withdrawals from pensions, IRAs, or annuities, and public assistance programs. Well, why would they allow you to increase your income on those tables based on non-taxable income? What would be the purpose of that? Well, the reason is that the table is meant to be a substitute for calculating the amount of money you would have spent during the year and therefore the amount you would have spent on sales tax during the year. So you would pay sales tax from non-taxable income as well as from taxable income. So the table takes into account all of the sources of income you could have had during the year, whether or not they're taxable. So it is not going to be the case that your computer will know the correct amount to enter on that very first line unless you go in and tell your computer how much income they had that would be above and beyond the adjusted gross income that they had. Now, if you were a part-year resident of your state, you need to figure the amount to enter on line 1 differently. You're going to have to factor for the state that you lived in and the number of days you were in each state. So let's just suppose you have 2 states. For state number A, you would need to look at the number of days you lived in that state, divide it by 365, because that's the number of days in a year, although for 2011, no, 2012 is a leap year. 2011 was not a leap year. So for 2011, you're going to divide it by 365 and then multiply it by the amount on the table. And for state number B, you do the same thing. So here's an illustration of what I mean. Mark is a single filer with income totaling $40,000, and during the year, Mark resided in the following states. He was a resident of Orange County, California from the 1st of the year through April 30th, and then he moved to Washington State and lived in Clark County from the 1st of May through the end of the year. In March, Mike bought a new boat, and he paid $2,720 of sales tax on the boat at the time of the purchase. Calculate his sales tax deduction for 2011 as follows. Now, based on Mike's income, the amount for a single exemption on each state is as follows. California, $662, and Washington, $615. The percentages that apply to the amount from the state sales tax tables are calculated as follows. Firstly, we look at the number of days he lived in California, 31 days in January, 28 in February, 31 in March, and 30 in April. That's 120 days of residency in California. We divide that by 365 in a year, and we get 0.3288. We multiply that 3288 by the $662 figure shown on the table to get the amount that he is going to be allowed to claim for the year, $217.67. We then look at the number of days of residency in Washington, and that's all the other months of the year. I add them all up, and I get 245 days. Into 365 is 0.6712. I'm going to multiply that by the 615 from the table for Washington, and when I do that, I get $412.99. I then add those two numbers up, and I get 630. 630 is the number I will enter on line 1. Because Mike resided in 2 different states that impose a local general sales tax, he has to complete a separate worksheet for each state he lived in and enter the prorated amount for that state on line 1. Now, if none of the localities in which you lived imposed a general sales tax, you wouldn't need to fill out 2 worksheets. You could just enter this amount from line 1 on 1 worksheet and fill it out. But of course, Mike resided in 2 states that have local taxes, so we're going to have to go through and fill it all out. The interesting part comes when we get to line 3. Line 2 does not apply because he's not going to be able to use the optional local rate tables. He's going to have to actually figure the tax manually. And it happens to be that the Orange County, California local rate is 0.5%. It happens to be that the Clark County local rate is 1.7%. So we enter those amounts on each individual worksheet for each individual state. Then on line 4, we check yes and enter 7.75 and 6.5 respectively. Those are the state sales tax rates for the states that he lived in. And the formula says take the state sales tax rate and divide that into the local rate. So you have to know the local rate and the state rate. You divide the state rate into the local rate to get a decimal amount. And for Orange County, that decimal amount is 0.0645, and for Clark County, it's 0.2615. We then multiply these decimal amounts by the amount that we calculated based on the state rate. So remember up here, we came up with the rate for California based on residency being 217, and the rate for Washington based on the number of days in Washington being 412. We then go down and multiply those amounts by the decimal amount we calculated. And the decimal amount is arrived at by taking the local rate and dividing into the local rate the state rate, and then multiplying the total amount for the state by that local decimal factor. So we're getting an extra $14 deduction for California and an extra $108 deduction for Washington. That's the bottom line of what that exercise is about. The next line on the worksheet says, stop everything and give me an actual sales tax figure you paid. Normally, they don't want you adding up receipts. You use receipts or the tables, but not both, but there's an exception, and the exception is when you purchase a big ticket item. So let's see what IRS means when they say big ticket item. It includes a motor vehicle, including a car, motorcycle, motorhome, SUV, truck, van, or off-road vehicle. Any state or local general sales tax is paid for a leased or motor vehicle, or sales tax paid on an aircraft, boat, home, including mobile and prefabricated or home building materials, if the tax rate was the same as the general tax rate. So some states will impose a sales tax when you buy or sell a home, and some states will not. They might have some kind of other tax. But if the tax that you pay when you purchase a home is the same as the general sales tax rate for the state, that is a qualifying tax deduction. If the state sales tax rates on these items is higher than the general tax rate, include only the amount of tax you would have paid at the general rate. Do not include sales taxes paid on items used in your trade or business, because of course that would get deducted on the trade or business. So essentially what happens is you use the tables to figure, use the tables and the worksheet to figure the deduction you're allowed based on your income and the number of exemptions you're claiming. And then in addition to that, you add in the amount of extra deduction you get for the local rate, And then on top of that, again, you add in any tax you paid on these big ticket items like motorhomes and cars. And when you're all said and done, you add everything up. So for the California, we had $217 as the amount paid for the state, $14 as the amount paid for the county, and happened to be he bought that boat before he left California. So the total amount of sales tax paid while he was a resident of California is going to be $29.51. And then he moves to Washington State, and the Washington rate was $413. The local is $108, and the total is $521. And now, of course, we're going to add these two numbers up to get $3,472. Well, that was a lot of work. Is there an easier way? Well, your software might make it easy for you. I can happen to tell you that my tax software they use in Drake, it handles residency in a single state quite well, but when you start splitting residencies between two states, it can't handle it. So you have to think outside the box. One way is to just fill the worksheet out by hand. The other is to go to the IRS website. There's a link here. If you click on it, it will take you to the IRS website calculator, and this is it. And what happens is the calculator pops up and it asks you to enter information like the number of days that you were living in the state and the zip code that you lived on in that state. And if you tell it that information, it comes up with this $3,472 for you. So I explained the kind of longhand how to get $3,472, but I wanted to show you that if you went to the IRS website and follow the instructions, you will get the exact same total. And this is a cut and paste. We generated this particular report on May 2 of 2012. And if you go and try it for yourself, you should get the same number, just for the fun of it.
Session 8 password number 3 is Wyoming. WYOMING.
Now in illustration number 2, I've got a simpler illustration this time. We have residency for the entire year in a single state, and I selected Clark County, Washington again. We have a married couple with 2 kids. The income on their 1040, line 38, plus non-taxable income not reported on Form 1040 was $80,000. They paid $40,000 for a new SUV during the year. Figure the amount to enter on their state and local income tax worksheet as follows. The first thing we do is we go to the table for Washington State. We find $80,000, scroll across until we get to 4 exemptions, and when we do that, we should get $1,056. Line 2 does not apply. We enter 0. Line 3 we already talked about earlier. The Clark County rate is 1.7. We're going to divide 1.7 by 6.5 because 6.5 is the state rate. And when we do that, we get 0.2615. We then multiply 0.2615 by 1,056, and we get 276. We then add the 276 to the 1,056, and then we also add in the amount of tax paid on that SUV. And when we're all done, we have a deduction of $4,612. We go to the IRS website, punch in all of the same information. It calculates $4,612 for us, and we enter that on Schedule A. It is entered on line 5. We've checked box B to indicate that we're claiming the state sales tax deduction. And we threw in the full worksheet completed as our tax software, Drake Tax Software, was able to generate it. Actual expenses versus the optional sales tax tables. Actual says add up the receipts. Optional table says fill out the worksheet and keep the worksheet retained for your records. So in summary, the tables give taxpayers a tax deduction and amount as an alternative to saving receipts throughout the year. In addition to using the amounts on the table, you are also allowed to use actual sales tax paid on big ticket items like cars, airplanes, and boats. Who gets to claim this deduction? Well, anyone can claim it. It's a matter of are they better off claiming it. And if you live in Alaska, Florida, Nevada, South Dakota, Texas, Washington, or Wyoming, those are states that do not have income taxes. So pretty much because they don't have income tax, the sales tax is definitely going to be the option in those states. If you live in any other state, each year you're going to have to look at the facts and circumstances and decide, am I better off claiming the sales tax deduction or the income tax deduction? And for 2012, there may be no option at all unless Congress gets busy. Let's see what happens. Real estate taxes. You may be able to claim a deduction for taxes imposed on real property that you own, provided the taxes are assessed based on the value of your property, they are levied for public welfare, the tax is imposed upon property that you own, and must have been paid by you. The taxes must be assessed to improve the value of your property. Taxes that are assessed to improve the value of your property are not deductible. So what they mean is we have a lot of this actually going on in the city of Portland right now. The city of Portland had a 100-year-old sewer system that was in really rough shape. It was overflowing into our river all the time and quite disgusting. So we were ordered to do a cleanup, our city was, and for the past decade, they've been digging up streets in front of people's houses and putting in sewer systems and so forth. So houses have been assessed levies for this, and that would be a good example of something that's going to improve the value of the house in many cases. And so if you're going from septic to sewer, or there's some levy that's coming in and carving out the street and putting in sidewalks, putting in paved road versus gravel road, and there's a specific levy on your property, those levies on the property increase the value of the property, are specific to your property, and are not deductible. All right? However, they do add to the basis of your home. So if you ever sell, it is a basis addition item. And I give you an example here. You are levied $2,500 to pay for sewer connections to your home. Because this levy is to improve your home, no deduction is allowed. Proration of taxes on purchase or sale of property. You are only allowed to claim a deduction for taxes that you pay on property for the period of time you are the owner. When you buy or sell a home, it is rarely exactly on the beginning or end date of a levy period. The levy periods in most states are either annual or fiscal. In Oregon, we're fiscal. We start on July 1st and it ends June 30th of the next year. Many states are annual, where you start on January 1 and end on December 31, and there might be some others that have another system completely. So if you buy or sell a home during the year, it's unlikely you're going to fall on the exact end of the levy period. And therefore, anytime you buy or sell, you're going to have to do a proration to figure out how much of the real estate taxes that have been paid on a home are going to be allocable to a period of time that you own it. So here's an example. You bought a new home in October of 2011, and then in November of 11, you received your annual property tax statement showing $2,000 as your July 2011 through June 2012 property tax levy. You will be the owner of your home for 9 out of the 12 months in that assessment period. For the portion of the assessment period that you were not the owner, which is July, August, and September, you must prorate your deduction to include only the portion of tax actually assessed while you are the owner of the property. So if you assume that the assessed tax is paid in full by the end of the year, you pay the $2,000, you're not going to be allowed to deduct $2,000. You're going to be allowed to deduct 75% of $2,000 because the first 3 months of the year, you were not the owner. The first 3 months of the assessment period, you were not the owner. Now here's another illustration where we actually got closing papers to show you how they work. In November, and we're looking at the seller's part of the property taxes here. In November of 2010, little Jimmy paid $2,592 of property taxes due on his home for an assessment period that runs July 1 through 2010 through June 30th, 2011. He deducted the taxes on his 2010 Schedule A Form 1040. Then on April 28, 2011, Bimbo and Betty Boop purchased the home from little Jimmy, and closing papers from the home sale are illustrated on the next page. Since the home sold partway through the July 1 through June 30 assessment period, the settlement statement shows that $447.40 is an adjustment item to the seller on line 107. What does it mean when it's an adjustment item? If it's for the seller, in this case, it means the seller is being refunded that money. Betty Boop, when she comes to the closing table, the money she brings to the table, she's going to need to bring that $447 and pay it down to Jimmy to reimburse Jimmy for the taxes she owes for the period of time she will be the owner. So that $447 represents the amount of tax assessed for the 63 days in the assessment period that fall after Jimmy sells the home. And since little Jimmy claimed a deduction for those taxes on his 2010 return, That $447 is a taxable refund that Jimmy has to report on line 10 of his 2011 1040. He's going to report it in the year he receives that refund. Now, let's take a look at a settlement statement here. This is a particular document that as tax preparers we need to be really good at reading and understanding. Most of the items that appear on a settlement paper like this have no bearing on the tax return, unless of course we're dealing with, say, a rental property. We're going to be looking at calculating cost basis in a rental property. Now, when your client sells a home, it can also be very relevant because it could be that they have a taxable sale, and then we're looking to figure out how much the profit on the sale of the home is. But just in the day-to-day, everyday business of doing a tax return, and a client comes in and says, hey, I bought a home this year, or hey, I sold my home this year, we need to be pulling very specific numbers off of these forms, even though they're filled with lots of numbers. So one of the numbers that I'm looking for is something that says county taxes. And this settlement statement shows on line 107 that there is a county tax assessment for a period of 4/28 of 11 through 7/1 of 11, and that proration is $447.40. This is a gross amount due from the borrower. The borrower is Betty Boop. The seller is little Jimmy. So little Jimmy's going to get this money back to him from Boop. It doesn't go to nowhere, it goes to him. So we're looking at that. Now here's another illustration. What would happen if little Jimmy hadn't paid the taxes yet? So I told you in illustration number 1 that little Jimmy paid his assessment for the fiscal period of July 1, 2010 through June 30th of 2011 in November of 10. So he prepaid it partway through the year, or he paid it partway through the year. But let's just suppose that he was hard up for cash and he didn't pay the whole bill in November. He only paid a third. What would happen then? So little Jimmy has decided to pay his 2010 through 11 property tax assessment in 3 equal installments. One payment of $864 was paid in November of 2010. He made a second payment of $864 in February of 11 and a third payment of $864 in April of 11. Because little Jimmy only paid 1/3 of his taxes in 10, his deduction for taxes on his 2010 Schedule A is going to be limited to $864. That's self-evident. You can't claim a deduction for something you didn't pay. But we get into 2011, where Jimmy paid the remaining $1,728 of tax prior to selling the home. And then on the sale of the home, he was refunded that $447. So he pays out $1,728. He's refunded $447. So we're going to subtract $447 from the $1,728, and we get $1,281. There's nothing in there that's taxable, but there is a deduction. And the deduction is the amount of tax he paid for the period of time he owned the home that was paid during the year. So little Jimmy will claim $1,281 as a deduction on his Schedule A for 2011. Now what about Betty? Bimbo and Betty Boop paid the $447 of tax at close as the buyer's share of property taxes when they purchased their home. Then in November of 2011, they received a property tax statement assessing taxes in the amount of $2,650 for the period of July 1 of 11 through June 30 of 12. The Boops paid that amount in full in November of 11. And the Boops will claim an itemized deduction on their 2011 Schedule A in the amount of $3,097. $447 of that is for the proration for the period of time they owned the house that they had to reimburse little Jimmy for, and the other one is the actual bill they received in the mail in November. So this would be a very key reason why a number that appears on a 1098 document would be incomplete or even inaccurate. If you have a payment going out of escrow for real estate taxes and the entire year that house is owned by that taxpayer, and for the entire fiscal assessment period for the taxes shown on that statement, they are the owner, you can go with the number on the 1098. But it is entirely possible that you have a 1098 with a property tax number in it, and that number is not the number you can use, either because they sold partway through the assessment period or they bought partway through the assessment period. Personal property taxes. Most states impose personal property taxes on cars. If you paid personal property tax on your car, you may be able to claim the tax you paid as an itemized deduction. To be deductible, the tax must be charged on personal property, be based only on the value of the property, and charged on a yearly basis, even if it is collected more than or less than once per year. Fees you pay for licensing or registration of your vehicle that are not based on the value of your vehicle are not deductible. Now, most states do have personal property taxes that are assessed on cars. Every year when you go to register your car, they look at the value of the car and make you pay a tax at the time you register that car. And that is an example of a tax that is deductible. But in addition to the personal property tax assessment, they probably have other registration fees that are not deductible. So you have to be able to pull out that number and claim only the correct amount. Taxes that you cannot deduct include fees and charges that you pay for a driver's license or registration. Transfer taxes. You cannot deduct taxes imposed on the transfer or sale of property such as your car or home. Federal income taxes, Social Security taxes, and Medicare taxes are not deductible. There is an exception that you can deduct the employer equivalent of the self-employment tax you paid as an adjustment to income on page 1 of Form 1040, line 27. But that has nothing to do with Schedule A, and you never deduct Social Security tax on Schedule A. You also cannot deduct fines or penalties. Penalties for violation of the law, such as parking tickets, late payment penalties, or speeding tickets, are not deductible. Licenses and fees, you may not deduct the cost of a marriage license, driver's license, dog license. Sorry. And then finally, where to deduct the taxes that you paid. This is a course about Schedule A and how to deduct taxes on Schedule A, but I did want to point out that taxes may be deductible in places other than Schedule A or instead of Schedule A. So I just put a table here to summarize that. So the table shows you what the deductible tax is and where you can deduct it. And state and local income taxes are deducted on Schedule A, line 5A. State and local sales taxes are deducted on Schedule A, line 5B. Foreign income taxes can be deducted on Schedule A, line 8, or on Form 1116 as a credit. Real estate taxes are deducted on Schedule A, line 6. Personal property taxes are deducted on Schedule A, line 7. Real estate and personal property taxes are deducted on Schedule E. Real estate taxes on personal property taxes assessed on your business are deducted on Schedule C. Self-employment tax, the deductible part of it, is deducted on 1040, line 27, and any other deductible taxes you might have paid are deducted on line 8 of Schedule A. So that ends the discussion on tax deductions for taxes.
Let's move on now to the Session 8 homework assignment, and I am on page 36 of the student manual for Session 8. The forms needed for completing this assignment are 1040, Schedule A, and a Schedule B. This is your first dabble into itemized deductions, and we've tried to keep it relatively simple, but you're still going to be challenged with sorting through a few numbers. And as a professional tax preparer, that is your job, to sort through a client's expenses and establish what is and is not deductible. Leonard Baker is married to Sue Baker. The Bakers live at 888 Baker Street in San Francisco and own their own home. Their son Mark, born in 1984, lived with them all year. Well, let me see. 2011 minus 1984, 27 years old. You need to register that. He earned $8,300, but his parents paid more than half the cost of his support. So their son Mark was born in 1984. He's 27 years old. He earned $8,300, and his parents paid more than half the cost of his support. Sue's dependent mother, Stephanie Martin, lived in a nursing home the entire year. Stephanie received $775 a month in Social Security payments. The Bakers paid the nursing home $1,900 each month for Stephanie's care. So your job is to determine whether or not Stephanie is a dependent and how much of a deduction can be claimed for her medical expenses. During the year, the Bakers had additional income and expenses as follows. They had a 1099 INT with Box 3 interest in the amount of $700, City of Fresno bond interest in the amount of $500, and a 1099 INT with Box 1 interest of $900. They also received a 1099 DIV showing Box 1A dividend income of $200, and in 2011, they received a refund of $400 for their 2010 return, and that is a taxable refund to them. Here are the expenses that they paid, and your job is to go through, sort through those, decide what's deductible, what's not, and then prepare their tax return. Here we have a W-2 for Leonard, and that's it.
And we are now at the conclusion of Session 8. Have fun completing your homework assignments and reading assignments for Session 8. I will see you next time at the beginning of Session 9. We will review the Session 7 quiz and the Session 8 homework assignment. Bye-bye.